Hi. Years ago, when I still had black hair, I did some boxing in university. It was the first time I realized the power of practicing the basics before you try something real, let alone something fancy. Each practice session was 2 hours. First, you jump rope for 15 minutes, then you hit the bag for 15 more, then you practice lefts, right, shuffle, shuffle, and again. And then you stand in a half crouch as the coach tries to hit you, while you shuffle, shuffle, and jump, jump, playing defense, before you're allowed to throw some jabs of your own. Finally, you lie on your back, and the coach drops a heavy ball on your chest and your stomach to teach you how to take an easy punch. Only then you go into the ring and mix it up with an opponent, which is when you see what training had missed, the real thing. So why do I mention all this in a channel dedicated to sleuth investing? For two reasons. First, because boxing is approximately how investing feels to me. It's punch and be punched, defense before offense, and if you're a pro, it's going the full distance of 15 rounds. And for this, you got to learn the basics. But second, because after 6 months of practice, once I finally got into the ring and managed to win, in points, but still, it was a win, only then the coach showed me a special trick. And it is this boxing trick that I want to talk to you about today, because I think the market may be going to play something very similar on all of us, maybe quite soon. As I said, at the time I had just won my first bout. No biggie, just 3 rounds, 16-ounce gloves. So when the coach said he'll teach me a trick, but in the ring, I said, okay. At the time I was about 6'6" and about 215 pounds. Today, I am 1 inch shorter and 10 pounds heavier. The coach, a Russian Jew who had learned his craft in Moscow, was at least 8 inches shorter and 30 pounds lighter. He was also 20 years older. So I said, yeah, sure, teach me. We went into the ring. For a while, we shuffled and danced around. Then he jabbed at me with his left, fast. I recoiled. A second left came. I recalled the second time. Then again. This was easy. Just going to the rhythm, no? But then he suddenly hit with the left again, not hard, just faster than before, breaking the rhythm. I felt it later on my chin, again not hard, but then came his right hook, very close behind it. The wall turned upside down, and I felt the floor hit the back of my head. I was knocked down. How? What happened? When I got up, he explained. There are tricks you can play in boxing, but you can play them only once. This one was called the metronome. It was a special trick invented in Russia by some street gang and picked up by his boxing club. What you do is hit the opponent with the left, fast, not even hard, which means you don't even use your hip muscles for power, which also help the speed. Then you hit again, maybe in a third time, steady rhythm, which makes your opponent get into a rhythm of backing away, then returning to position, backing, then returning. But once the opponent got into the rhythm, you break it, like this. 1, and again, 1.5. And it's that unexpected last half that gets him. And during the brief second of surprise, you can actually see it on his face. You then hit him with the right. Only this time you use all your hip muscles, your shoulder muscles, your arm muscles, even your wrist muscle for that final snap. And this right can often be a deal clincher if you give it everything you got. But there's one thing to remember. You can only use the metronome once, because once you use it, the opponent learns, and he will never fall for it again. I sure never will. So why do I mention it in the channel about sleuth investing? Because the stock market, which is the grandmaster of all wily opponents, may just be preparing a grand metronome feint to hit all of us with. Prepare how? And what sort of feint? In a word, the market may be preparing an inflation feint. And if it does, it can be a dilly. Let me explain. For the last year, every forecaster and economist, whether on Wall Street or Bay Street or just on the internet, have been screaming that inflation is coming back because of the Fed money printing and because of the broken supply lines and all the ships laden with merchandise lying in harbor and the scarcity of loading cranes and the problem of oil companies not drilling. So oil is going to $100 a barrel, maybe more. And used cars selling for more than new cars because half the workers have been staying home because they don't want to take a jab. and food prices and house prices. In a word, the market keeps hitting you with a left jab whose knuckles are tattooed with the word inflation. And again, and again, and again, inflation is coming. Get into the inflation trade. Inflation is coming. Bam, bam. Yes, it's coming. And again. But let's see now. If inflation spikes up further, as it will, for a little while, what will the Fed do? Print less money. That's what, i.e. taper. What will the bond market do then? Sell off. What will interest rates do? Temporarily spike up. And what will the stock market do then with higher rates? You got it. It will tumble. Only this time, if and when it begins to tumble, it will continue to do so. Why? Because growth of stocks' margin debt is as high as it has ever been at the previous two market peaks, meaning that investors are close to tapped out, both cash and borrowed money, which means that if the market tumbles as higher rates break its rise, both the market and the economy can start on a long way down, which is when the market right hook can come in. Bam! Because as the market tumbles, the economy, which is levered more than ever before with derivatives up the wazoo, could crack too. And then all the merchandise in the ships that would finally be liberated will start coming in. And the owners will have to cut prices to sell them. And these cut prices and the urgency to sell the inventories will bring in lower prices. That is deflation. Bam! In other words, after a few faking straight left jabs getting you and the Fed into a rhythm of inflation, once the Fed tries to reduce this inflation, it will likely overreact, and so will the bond market, which will tip the market over, which in turn will bring in deflation. So, just like a boxing match with the opponent trying to accustom you to a rhythm before it hits you with the other hand, I'd watch here for a spike in long rates in the next 3 to 6 months, which will bring the Fed's right hook of tightening money supply. And then, before you know it, the market can be down 20%, then another 20%, and perhaps 20% more. Bam, bam, bam. When can this happen? Who knows? But now the main question, how can this boxing analogy help amateur market boxers avoid being knocked down? Perhaps even help them win on points. Now remember, the above is not a forecast, just a theoretical scenario. But under this scenario, I'd say that one should forget about the inflation trade here. The market screaming inflation is probably the last swing of a fake metronome that wants you to get deeper and deeper into the trade of yesterday. I'd rather be thinking here of lightening up into the rise than wait for the market to reach peak euphoria with the fear and greed index at 90 plus, as it was in 2019 year end. Then I'd consider going into US dollars and US bonds, because if deflation is coming briefly for 6 months as the market craters, maybe, then bonds would fly, as with the US dollars were all other currency, since in a market decline, let alone a crash, the US dollars and bond are the only safe assets in the world. Of course, I could be wrong. However, my old boxing instinct and my gray hair are sniffing a market fake coming up. And as in the ring, in the market too, it is better to be safe than sorry. Because if you are safe, you can always come back and fight another day. That's all for today. Please let me know in a comment below what you think of the above. Give it a like, subscribe to the channel, tell all your friends to subscribe too. I'll see you next time, and meantime, thank you very much for watching.